Financial freedom is a goal that many aspire to achieve, and one of the most effective pathways to this independence is through earning passive income via investment dividends. What are dividends, you ask? Dividends are payments made by corporations to their shareholders, typically derived from profits, and they represent a way to earn money without actively working for it. This concept of passive income is ideal for those looking to build wealth over time, as it allows individuals to generate a steady stream of income that can supplement their own earnings or even replace them entirely. Achieving financial independence is not just about accumulating wealth. It's about creating a lifestyle where you have the freedom to make choices without being constrained by financial obligations. This concept resonates deeply with those who may be seeking ways to escape the traditional 9-to-5 grind. Let's explore various strategies for leveraging dividends to enhance your financial situation. We will discuss how to identify dividend-paying stocks, the importance of reinvesting dividends for compounding growth, and how to build a diversified portfolio that can withstand market fluctuations. Stick around till the end and you will have a better understanding of how to harness the power of dividends to work towards your financial goals. So let's define it further. Dividends are a portion of a company's earnings that are distributed to its shareholders, serving as a reward for their investment in the company. For shareholders, dividends represent a tangible return on their investment, providing a steady income stream that can be reinvested or used for personal expenses. The significance of dividends lies in their ability to enhance overall investment returns, making them an attractive feature for many investors. Companies typically decide to distribute profits to shareholders based on their financial performance, growth strategies, and cash flow needs. When a company generates profits, its board of directors evaluates how much of that profit should be reinvested back into the business for growth, and how much can be returned to shareholders in the form of dividends. This decision is influenced by various factors, including the company's long-term goals, market conditions, and the need to maintain a competitive edge. How do you receive dividends? Investors can receive dividends in several ways. The most common method is through cash dividends, where shareholders receive a direct payment, usually on a quarterly basis, deposited into their brokerage accounts. Alternatively, companies may offer stock dividends, where shareholders receive additional shares of stock instead of cash. This can be beneficial for investors looking to increase their ownership in the company without incurring additional costs. Some companies provide dividend reinvestment plans or DRIPs, allowing shareholders to automatically reinvest their dividends to purchase more shares, thus compounding their investment over time. Understanding how dividends work and their various forms can empower investors to make informed decisions that align with their financial goals. So now that we've covered what dividends are, let's talk about strategies to leverage them. Dividend yield is a concept for investors seeking to assess the income potential of their investments. For example, if a company pays an annual dividend of $2 per share and its stock is currently priced at $40, the dividend yield would be 5%. This metric provides investors with a clear indication of how much income they can expect relative to their investment, making it an essential tool for evaluating potential stocks. However, it's important to note that dividend yields can vary significantly among different companies and industries. Some companies, particularly those in mature sectors, may offer higher yields as they distribute a larger portion of their profits to shareholders. In contrast, growth-oriented companies may have lower or even no dividend yields as they reinvest profits to fuel expansion. This variability highlights the importance of understanding the context behind a company's dividend yield. Evaluating dividend yield is vital when considering investment options, as it helps investors gauge the attractiveness of a stock compared to others. A higher yield may indicate a more lucrative investment, but it's essential to consider the sustainability of that yield. A company with a high dividend yield may be facing financial difficulties, leading to potential cuts in dividends. investors should be diligent and analyze the overall financial health of the company and its dividend history. By understanding dividend yield and its implications, investors can make more informed decisions that align with their income goals and risk tolerance. One effective strategy for earning dividends is through covered call exchange-traded funds. Covered call ETFs are investment funds that hold a portfolio of stocks while simultaneously selling call options on those stocks. This strategy generates income by collecting premiums from the sale of the options, which can then be distributed to shareholders as dividends. Essentially, the fund manager writes call options on the underlying stocks, allowing investors to benefit from both stock appreciation and the additional income from option premiums. Popular examples of covered call ETFs include the Global X Nasdaq 100 Covered Call ETF, known by its ticker symbol QYLD, and the Invesco S&P 500 Buy Right ETF, ticker symbol PBP. These funds have garnered attention for their attractive yields, often exceeding those of traditional dividend-paying stocks, making them appealing to income-focused investors. For instance, QYLD has historically offered yields around 10% or more, attracting those seeking higher income streams. However, while the potential rewards can be significant, there are also risks associated with this strategy. One primary risk is that if the underlying stocks experience substantial price appreciation, the ETF may miss out on those gains because the call options limit the upside potential. If the market declines, the value of the underlying stocks may decrease, impacting the overall performance of the ETF. Investors must also consider the tax implications of option premiums, which can differ from traditional dividend income. Overall, covered call ETFs can be an effective way to generate income through dividends, but it's essential for investors to weigh the potential risks against the rewards and ensure that this strategy aligns with their investment goals and risk tolerance. The second strategy for earning dividends involves investing in real estate investment trusts, or REITs, which are companies that own, operate, or finance income-producing real estate across various sectors. REITs play an important role in generating passive income for investors by allowing them to invest in real estate without the need to directly purchase or manage properties. By law, REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends, making them an attractive option for those seeking regular income streams. Some examples of high-yield REITs include the Annaly Capital Management, which focuses on mortgage-backed securities and has historically offered yields around 10%. The Realty Income Corporation is also known for its monthly dividend payments and yields typically around 4 to 5%. These REITs provide investors with opportunities to earn substantial returns through dividends while diversifying their portfolios. Historically, REITs have demonstrated strong performance, often outpacing traditional stocks and bonds over the long term. They can provide a hedge against inflation, as real estate values and rental income tend to rise with inflation. However, investing in REITs also comes with risks. Market fluctuations can impact property values, and economic downturns can lead to decreased rental income and higher vacancy rates. Interest rate changes can affect REIT performance, as rising rates may lead to higher borrowing costs and reduced attractiveness compared to other income-generating investments. While REITs can be a powerful tool for generating passive income, it is essential for investors to conduct thorough research and consider their risk tolerance before diving into this investment strategy. The third strategy for earning dividends centers around investing in dividend aristocrats. These are companies that have consistently increased their dividend payouts for at least 25 consecutive years. These companies are significant in the investment world because they demonstrate a strong commitment to returning value to shareholders, reflecting financial stability and resilience through various market conditions. Dividend aristocrats are often seen as reliable investments, appealing to those seeking both income and long-term growth. Notable examples of dividend aristocrats include companies like Johnson & Johnson, which has a yield of around 2.5%, and Procter & Gamble, with a yield of approximately 2.4%. These companies have established themselves as leaders in their respective industries, consistently rewarding shareholders with increasing dividends over the years. Investing in established companies with a history of dividend growth can offer several benefits. First, these companies tend to have strong cash flows and solid business models, which provide a cushion during economic downturns. This stability can lead to less volatility in stock prices compared to non-dividend-paying stocks. The practice of consistently raising dividends often signals management's confidence in the company's future earnings potential, making dividend aristocrats attractive for long-term investors. Reinvesting dividends from these companies can significantly enhance total returns over time through the power of compounding. This strategy not only provides a steady income stream, but also positions investors to benefit from capital appreciation as these companies continue to grow. Overall, investing in dividend aristocrats can be a prudent strategy for those looking to build wealth while enjoying the security of regular dividend payments. Understanding dividends and the various investment strategies associated with them is crucial for anyone looking to achieve financial independence. So let's recap. We explored several key strategies, including earning passive income through covered call ETFs, investing in real estate investment trusts, also known as REITs, and focusing on dividend aristocrats. Each of these approaches offers unique benefits and opportunities for generating income, allowing investors to build wealth over time. By grasping the significance of dividends and how they can enhance your investment portfolio, you can make informed decisions that align with your financial goals. I encourage you to speak with your financial professional to explore if these strategies are right for you. Remember, the journey to financial freedom begins with informed choices and proactive steps. If you found this video helpful, give a like and subscribe for more simple, straightforward financial topics. Be sure to check out other videos on this channel like this one here.